Welcome back to a new weekly outlook. We're going to go over the fundamental analysis, translate that into market sentiment, and then take a look at the technical analysis for any scalping, day trade, and swing trade opportunities across US equities, currencies, and commodities. So starting off with the macro fundamentals, this is a week where two US releases, jobs and CPI, are close together, so the market can reprice rate expectations twice in 1 week. At the same time, we have fragile equity liquidity, systematic flow risk, and ongoing geopolitical risk premiums. So the base case for this week is quite simple. We're expecting higher volatility, more stop runs, and faster reversals, especially around US data and Tokyo, London, New York session transitions. The most important fundamental driver this week is the compression of US macro catalyst, the January jobs report, and CPI, which are landing unusually close together because of the shutdown delays. We were supposed to get the NFP data last week on Friday, but because of the US government shutdown, it got pushed to this week on Wednesday. And then within that 72-hour period, we also have CPI that's going to be coming out right after. Why do we care about that? Because the market basically does not get time now to digest one before repricing the other. And from an institutional, bigger investor, bigger player, whatever you want to call it, from their perspective, this is important because of whatever's inside that jobs report. Number one, it's the headline payroll print and the unemployment rate. Of course, we know that, but more importantly, the annual benchmark revision. And that revision is essentially a structural reality check on the prior year's labor strength. If the revision marks payroll levels down meaningfully, then it changes the entire soft landing confidence profile that we have been fed so far. Then we have CPI that's going to hit. And the focus won't be on the headline volatility, it'll be on the core inflation and the services style persistence. Anything basically that signals that inflation is sticky versus actually normalizing. So the macro setup here is that the market is entering the week with uncertainty on growth and uncertainty on inflation at the same time. That's why cross-asset correlations will be unstable and why we can get both risk-on rallies and risk-off flushes within the same 48-hour window. Now, if we were to translate this over to policy expectations, what does it basically mean? The Fed in the most recent meeting held the rate steady, and we have Fed speakers this week, including officials who have been willing to dissent in the favor of cuts. But the Fed can't sustainably pivot unless either the labor market deteriorates faster or number two is inflation convincingly decelerates. In other words, the Fed is truly data dependent, but it's not symmetric. A hot CPI is immediately US dollar supportive because it pushes out the expectations of potential rate cuts that we're expecting was going to happen in March, but now it's in June. And if CPI comes out even hotter, then it continues to push out those expectations. A soft jobs number, especially with a big downward benchmark revision, will create a two-step reaction. The first one is initial risk off in US dollar strength, and then potentially US dollar weakness if the market starts pricing policy easing. So when it comes to Forex this week, the market isn't trading the dollar, it's trading the direction of repricing in the front end and what that implies for risk appetite. Then we also have news around consumer credit that is rising sharply, which is a big jump in revolving credit and a solid rise in non-revolving loans. From an institutional or big player investor, whatever you want to call it, they interpret that two ways depending on the macro backdrop. In a stable jobs environment, it can look like confidence and spending resilience. In a weakening labor narrative, it can look like households bridging consumption with leverage, which increases tail risk. And the most important detail here is not that the credit rose, but it's that income growth is lagging spending and the delinquency expectations have been rising. That is exactly the kind of late cycle signal that makes equity and credit desk more sensitive to a negative macro surprise. So going into jobs and CPI, the market has less tolerance for bad news because household balance sheets are starting to look less clean. Now moving over to Bank of England. The Bank of England story this week is unusually clear. They believe that inflation is coming down towards target, but the cost is a weakening labor market and a higher projected unemployment. The Bank of England held their rates at 3.75% in this most recent meeting, but it was pretty close. And the internal debate is essentially, do they keep policy restrictive to fully anchor inflation, or do they cut sooner to avoid a sharper labor deterioration? this is important for any pound pair, whether you're trading GBPUSD, whether you're trading GBPJPY or anything else, because number one, the pound is supported when the market believes that the Bank of England can stay restrictive without breaking the economy. And number two, the pound becomes sensitive and exposed when the market starts pricing that Bank of England has a need to cut faster than we expect because the jobs market is rolling over. So the fundamental lens for the pound this week is that the pound is not a pure inflation trade. It's a growth, fragility, and policy reaction function trade, which makes the pound sensitive to both US data and any UK growth and labor signals. Then on Japan's front, this article reintroduces something that traders often ignore until it hits them, which is that intervention risk. Japan's finance leadership is signaling they're ready to communicate with markets quickly, and they're explicitly referencing the ability to take decisive action against rapid moves out of line with fundamentals. And that changes the microstructure of USDJPY, GBPJPY, if you're trading EURUSD or any other JPY pair, because it doesn't automatically make the yen strong, but it makes any yen shorts more nervous, which increases the probability of violent short covering squeezes, especially around illiquid windows. And the other fundamental angle here is the fiscal credibility. If Japan's government is seen as tilting towards proactive fiscal policy, while debt sustainability is questioned, then that can weaken the Japanese government bond sentiment and distort the Forex flows. So overall, the yen remains a funding currency, but positioning is crowded and policymakers are watching. That means that the yen moves can be asymmetric and the market will respect the threat, even if no action actually occurs. Then we also have updates when it comes to some geopolitics. And this is where people make the mistake of thinking that it's only an oil story. The US-Iran indirect talks reduce immediate escalation risk, but they don't remove them completely. The market is still pricing a risk premium in crude because the downside scenario is not incremental. It's a supply shock narrative. And the critical linkage here is that oil doesn't just move oil, it moves inflation expectations. And inflation expectations move rates pricing, and rates pricing moves the US dollar and gold. So if oil spikes on negative headlines, then we can basically expect a quick chain reaction, which is basically higher inflation risk, which leads into less confidence and fast Fed easing, which leads into higher real rates and stronger US dollar impulse. And finally, that leads into pressure on gold in the immediate term, unless the move is pure risk off fear. So that's why sometimes gold sells off on an oil-driven inflation shock, and other times it rallies on geopolitical risk off. The difference is whether the market is treating the event as inflationary or as systemic risk. Then we also have updates when it comes to Ukraine. On Ukraine, the key market detail is that the conflict continues with infrastructure strikes and the diplomacy is slow. The market is somewhat desensitized to incremental headlines, but it still matters for two channels. First one is energy security risk in Europe and broader risk sentiment when it comes to escalation risk as it rises. And that tends to show up more in the euro behavior during risk off and more in gold during broad uncertainty spikes. Now, the most important market sentiment input from all of these articles is the flow and position backdrop in US equities. The equity market is dealing with three things at the same time right now. Number one is the systematic selling risk from trend following strategies. Number two is a thin top of book liquidity, which means that price moves further on less volume. And number three is a shift towards flat to short gamma, which means that dealers tend to buy into rallies and sell into drawdowns in a way that can amplify the swings, which matters beyond equities because equities are the risk engine for Forex positioning. And when equities get choppy, then they'll do two things. It increases the demand for safe havens like the yen on risk-off impulses, and it reduces the willingness to hold leverage positions in high beta trades like GBPJPY. So going into jobs and CPI data, institutional behavior is not buy dips aggressively. It's rather trade smaller, hedge more, and let the data decide the next repricing. That is why this week is structurally set up for false breaks, liquidity runs, and fast reversals, especially around the data and session handoffs. So that is the overall macro fundamentals. Let's take a look at the economic calendar. We already know that Wednesday and Friday are the main days that we really care about. But we started off quite easy. Tomorrow we have the retail sales that are coming out from the US. So if you're scalping, then you might find some great opportunities around New York Stock Exchange for that. Wednesday, of course, you have NFP. Everyone's watching that very closely. So we're of course going to have a lot of liquidity runs right before that. We're going to get massive wick rejections. We're going to get a lot of potential consolidation even leading up to this actual news release. And then after that, I'm expecting a lot more volatility as soon as it's released until the market can find its direction. Then Thursday, a little bit easy here again. And then going into Friday, we have CPI data that's going to come out. So let's start off with US 30, obviously still in a very bullish structure here from a technical perspective, but the core sentiment here is still very sensitive, very fragile. The market is very sensitive to forced selling from systematic strategies if the downside momentum continues, and choppy liquidity conditions will make intraday ranges expand even more. So this is not going to be a very clean trend tape. It's a tape where flows can override fundamentals temporarily. So we're going to be extra careful this week when it comes to any potential trade opportunities. On the daily time frame, we just broke out of a multi-day consolidation. So that's why we're being extra careful here as well, because I want to see price coming back up into 49, let's say 600, 700, any of these levels, and reject here. The previous daily candle did gap up when the market opened up, but it came back and it closed back down bearish with a nice bottom wick rejection. We don't have a clean direction here just yet, but I am going to mark off that resistance up top at 50,200. Let's drop down to the 4-hour time frame, and that's kind of the area that we're hugging at the moment. So what I want to see for any sell opportunities, even if it's a quick scalp, I want price to come back down below the $50,000 mark, closer to 49,900, and then as it breaks down, then I'm expecting a retest of that 49,600 area, which is a very strong level. So if price can reject that and then push back up bullish, then we can look for those buying opportunities. I do think that this is going to be our range for this week until NFP comes out or even CPI. Drop down to the 1-hour time frame. So today you didn't really have a lot of opportunities. It is a pretty big range in a sense, but it's just a lot of consolidation, no clear direction. So if the market just stays in here, there's really no trading opportunities when it comes to day trades or even swing trades. If you're scalping, you're just looking for a trade zone to zone, nothing in between. NASDAQ is pretty much the same thing as US 30, but we do have nice little support that's being formed here. And then we also have our weekly resistance. So same thing here. If price is hugging either support or resistance, you can look for your scalp opportunities, but not so much going on when it comes to day trade. What price did here also is it came back down into the zone, grab that liquidity, which is really where price had the momentum to come back and tap into, let's say, 26,250 area. Came back down, tapped into that area again just to come back into 25,800. So overall, this big zone here is more of where the supply zone is sitting. That's where a lot of the liquidity is also sitting up top here. So unless we have the fundamentals that will really push and be the drivers, then we're not really going to look for the technical setups for a longer term play here. If anything, we're simply looking for some scalp opportunities. Once again, just zone to zone trades that are going to happen here. And then if you do see that price is breaking past that 25,800, then your next target is going to be around this 26,200 or 250 area. Before we look at GBPUSD or even EURUSD, something that I did want to note when it comes to the US dollar, just on a broader sense, is that the dollar is being driven by front end repricing right now. A hot CPI will support the US dollar directly. A weak jobs print can initially support the US dollar via risk off, and then weaken the US dollar if the rate cuts get pulled forward. So that's very important to know when we're looking at EURUSD, GBPUSD, and even USDJPY, but specifically the pound versus the dollar and the euro versus the dollar. Right now, when we're looking at GBPUSD, it looks like the pound is caught between Bank of England fragility and the US dollar repricing risk. So the pound can perform when risk is stable and the Bank of England can hold, but the pound will underperform when growth fears dominate or when the Bank of England is forced into earlier cuts. So from a fundamental perspective, that's also very important to know for about any pound pairs, but specifically when it comes to the pound versus the dollar. Based off of the weekly time frame, we are still rejecting this previous very strong resistance level, which was previously support as well, which is 1.372. That is currently our weekly resistance. And even if price does break past that, then we're simply looking for a wick fill, because the higher the time frame, the stronger these levels are going to be, the more confirmations that we need prior to a continuation trade or a swing trade here. I like to keep my pound versus the dollar or euro versus the dollar or any major pairs for more of the swing trading instead of scalping or day trading. Then we have our 1.356, which is our weekly support. So as you can see, previous resistance, and then we had a little bit of pullback and then a massive sell-off there as well. But this is where the fundamentals are going to be very important when it comes to figuring out if we have a continuation trade here or not. Right now, it seems like we're pretty close to that resistance, so this is why we're going to be extra careful too on the daily time frame to see if we will end up getting a top wick and then a flip back down. If that happens, we can look for ourselves to come back down into 1.356. If price makes a bottom wick and then flips back up, then you want to be extra careful around this area. You can look for your day trade opportunities here, but you need price to break past that 1.372 area. Right now, we're kind of sitting in a pullback. We have an established support. It's just a matter of, are we actually going to have that bullish volume to break the previous high, or are we actually just going to consolidate here? Now, when it comes to the euro versus the dollar, the Euro-USD sentiment here overall is cautious. Without a clear US-driven US dollar weakness impulse, the euro will struggle to trend cleanly. And the euro can still rally, but it needs either a dovish repricing of the Fed path or a broad US dollar de-risking event, which is really going to be the main fundamental catalyst for this pair to continue pushing past the current weekly resistance levels that it's struggling to break. Which is at 1.193. And then we also have the previous weekly candles bottom wick rejection right here that I'm marking off as a support. And that is 1.178. Drop down to the daily, and we have a very clear daily support here from a consolidation. The previous daily candle, the one that just closed back up bullish at 1.193. So let's see if we are going to come back down, if price is going to consolidate, but because again, we're waiting on the major fundamentals this week, or if price can actually break past that 1.193. If that happens, then we're looking for a day trade opportunity to come up for about, or even a swing trade opportunity for about 156 pips to the upside. So which is a really good range if you're swing trading this, but we need our confirmations that price is going to break past that 1.193. If price holds onto a resistance here and then pushes back down, then we're looking for sells right below this area where we've had a lot of rejection. And we're looking for a range of about 117 pips to the downside to come right back and tap into 1.178, or at least retrace this massive bullish momentum that we have after this daily consolidation here. Then we have our GBPJPY, which is sitting at a very key historical price level based off of higher time frames as well. The JPY in general, whether you're trading USDJPY, GBPJPY, or EURUSD, right now the sentiment is asymmetric. It's a funding currency, but intervention risk increases the probability of sudden squeezes here. So when it comes to this particular pair, that means that the upside can grind, especially when we're sitting at a very historical level of the weekly resistance. And that price has not come back and revisit that area since 2008. So that's also another important thing to take into account while you're trading this pair. But downside can drop faster than most traders will expect here if we have the fundamentals that will really support this entire push. So looking at this based off the weekly time frame, we have our resistance, which is sitting at 214.2. We have our weekly support right here into that weekly little consolidation area too, which is 210.8. Come down to the daily time frame, and you have this bit of area that you want to be careful of where you had that daily consolidation, a little bit of a push up for about 242 pips, which is really where we tapped into the previous 2008 levels, pulled right back down, tapped into that support, held onto a resistance just to come back and tap into the same exact level here once again, pulls back. So that's really the behavior that I'm really expecting here. When it comes to the 4-hour time frame, we've had this current 4-hour candle that gapped down, pushed up to fill in the gap, made a top wick. So we're kind of sitting in uncertainty at the moment. If I really want to look for scalping opportunities here, the very first level that I want price to break below is going to be the support. To come back down for a wick fill, then you have a potential opportunity for about 111 pips for a scalp that could turn into a swing trade. But ideally, what I would like to see is price pushing up further into 214, holding onto a resistance here, like these instances, and then push right back down. That's a much better sell. That way you can take partials here and then let everything else run to come back down into the 211.5. We know for a fact from historical price action that if price rejects that 214.2 area, if it's really not able to break past it, then it is going to come back down into 211.5 zone. Now we have our USDJPY, and we are looking at the weekly time frame. Zoom out, pretty much seems like another key level that price is tapping into, and it's just consolidating here. That is 158. And then we have our weekly support right around here. So that's where price held onto a support here. A previous resistance here too, and a break and retest support that price tapped into before rallying back up. So that's the same exact level that I want to watch out for as well. And that's going to be my zone for this week. Drop down to the daily time frame, and we see that price pulled right back down here, held onto a support. You can take a look at what price has been doing here historically too, which seems to be another major support before a massive push back up. A nice little retracement here too with a bottom wick rejection, another nice rally up. So overall, we know that we are expecting some bullish volume here to the upside, which, you know, price has already done. But we want to see if it can hold on to a support here and then continue pushing back up bullish for that continued buy opportunity. If that happens, drop down to the 4-hour time frame. Very first thing, it seems like we're still in a retracement mode. So wait for price to come back closer to 155.2 area. If it can hold on to a support here and then rally back up, we're looking for those buys above 155 point, I would say 9 or even 156, just so we can clear out of that previous area right here. And then look for those buys to the upside. We are looking at a range of about 205 pips to the upside, and then maybe a little bit more if you want to let runners go. If price fails to hold on to 155.2, I want to see a break and retest formation. So either a retest of 155.2 or a little bit higher, just to respect these previous areas of support where we basically had a gap, a bit of a retracement. That's where price is sitting at right now. So anywhere here, and then a further sell-off opportunity to come back down into that 152 area. It seems like from higher time frames that price only comes back to 152 when it needs more liquidity, because based off of the higher time frames, like on the weekly, price was stuck in a consolidation here. So it gapped down here, made a bottom wick rejection to grab that liquidity just to come back down or come back up into this consolidation here. So those are going to be our two setups for USDJPY for potential scalps that can turn into swing trades. Then coming to gold, we're sitting at all-time highs. Same exact levels from last week, and I believe the week prior as well, where 5,100 is going to be a very important level. I want price to break above that prior to looking for any buying opportunities. And then when it comes to support, I'm actually going to mark that off of the daily, where I see that price is holding onto a support down here, which is 46, let's just call it 60. Right now for gold, the sentiment is split between two regimes where we have inflation repricing versus the risk of hedging. And if oil-driven inflation risk rises and real yields rise with it, then we can see that gold will face pressure. But if the market interprets the environment as systematic uncertainty, then gold will catch a bid here. So those are our two fundamental catalysts. Then coming over to the 4-hour time frame, no trade zone is still between that 5,000 and 5,100 level, so I'm not looking for a trade down here. But if price can break below that 5,000 mark and continue pushing back down on, let's say, the 4-hour or even the 1-hour time frame, then I have my clean sells right below this zone here. Then I can look for sells to come back down and tap into about 4,900. And then if price continues pushing further down, then we have 4,800. But it's a very strong move if price does end up coming back down to 4,700 or below. We would need some fundamental catalyst there, but looking at All the other assets, it seems like we might see a little bit of consolidation until we get closer to tomorrow, where we have the core retail sales, a red folder, but then also Wednesday and Friday. And let's go over silver. For silver, this amplifies whichever direction that gold commits to, but with more violent mean reversion risk here. So we're always going to be watching gold first to kind of see what is the direction. And then if you're up for it, then you can absolutely trade silver as well. So we have our support at 77.82. And then my resistance, let's come over to the daily time frame. It's going to be 88.70. So we do have a pretty good range when it comes to potential scalping opportunities. Based off the daily time frame, I just want price to remain outside of this resistance area, this little bit of consolidation. So how it's forming up right now, basically with the current daily candle, the 4-hour candle barely closed out of the range. So if the next one can simply make a bottom wick and flip back up, then we can trade this range here. But if it comes right back down, then this is my no trade range. For any sell opportunities, I need a break below 76 clean, and then a continuation down for a wick fill into this area. But it seems like, again, we're probably going to be sitting in a consolidation here. So basically, your clean catalyst map for this week is going to be in the early week. We're going to see more of the positioning, more of the liquidity, which is going to be the main story. So we are going to be expecting stop runs. Then midweek, as we're getting closer to the jobs report, we have the jobs report plus the benchmark revision. So we're going to watch the repricing in rate expectations and the immediate risk response to that. Then at the end of the week, we have CPI, which can reinforce or reverse the midweek move that we have. So we have great opportunities that are setting up for when it comes to scalps, some for day trades and not so much just yet for any swing trade opportunities. And because these releases are stacked, the probability of a single clean weekly trend is going to be lower here. So the probability of two-way volatility is actually much higher. Now, with that, make sure that you guys are managing your risk very properly. You're using proper risk management. You're using smaller trade sizes than usual, but your focus this week needs to be most on your risk management. I will see you guys in the next weekly outlook. As always, if you have any questions, feel free to reach out on Instagram at SharmaFX, or even comment your questions below and I will go ahead and answer that whenever I get a chance.